Good morning, traders. It is Friday, the last trading day of the week. It is October 14th. We are about an hour before the open. A lot of excitement right now because it looks like the market might have put in a temporary low. We don't know for sure. Everybody's always asking me to trade while I'm doing these videos. I don't typically like to trade the pre-open. I do like what I saw yesterday in the market. I don't know if there's going to be a lot of follow through. So here's what I'm looking at right now. I'm looking at this low that was established earlier. Nice bullish hammer here. We try to get back to this high, start to see some resistance up in here. Stacked long red candles. Again, this is pre-open. This would look very good from a bullish standpoint. This looks pretty compelling from a bearish standpoint. I've got my 1OP indicator that's starting to fall. Looks like a base could be forming. I am looking at a possible higher low, double bottom. This red candle, I would like to see it reversed very soon in here. If it does, I'm going to be tempted to buy right in here, take profits a little bit higher. We'll see if this plays out. I'm also watching for this 1OP cross. How do you trade 1OP? So if you came into the after hours session, we have a gradual decline on a bearish 1OP cross. We get a bullish cross right in here. That means that you should be generally long. This bullish cycle runs, we get a bearish cross in here. Now we have technical confirmation because this support level has been breached. Yes, this would be a good short. So now you get a bullish cross. What do you do with this bullish cross in here? Well, you should be on high alert to take profits on your short because you've got some nice gains in it. So you're watching and monitoring what the price action is telling you. Half of this long red candle needs to be preserved, and it was. And you see two nice bearish hammers. So yes, you can stick with the position and you get the next leg lower. So you didn't have technical confirmation on this bullish cycle, and that is actually a bearish divergence. So that means stick with your bearish position. Market comes down. Now you have another bullish cross here. Okay, well, is the support going to hold? You don't really know here. These are tiny bodied candles that can be reversed very quickly. Whap! Okay, so that tells me that sellers are still around. I'm still looking for this support to be confirmed. Now we start biting back into this red candle. Now we actually have a close above the open of this red candle. Yes, now I can take this bullish cross. Also, that was a bullish hammer off of a new relative low. This is a bullish cycle. Fantastic. So we know right in here we had a bearish divergence, market down, indicator up, and this bearish cycle completes. Double bottom, bullish hammer, bullish cross, everything is in place. So we've got an upward sloping trend line here. We hit this resistance level. Now we have a long bearish engulfing candle. Yes, you could try a short in there. So this is what I'm watching right now. Let's see, I want to see support here. I'd like to see us be able to get above the open of this red candle. If we can, I'm going to be taking a long position. I'll only do one contract for purposes of the video. So I'm going to load that order up and we'll see what happens in here. But I'm pretty optimistic that we're going to get at least a bounce in here. Why? Because yesterday, if you take a look at the 5-minute chart, we'll go into the SPY, you'll be able to see very, very heavy volume. And there's the 5-minute chart. Look at that volume. Well, that means that there's a lot of conviction, whichever way we're going, up or down. And so we come into the opening here and we get this big gap down. So if this were a gap and go formation, I've seen enough here. This is telling me that we're going to bounce a little bit in here, so I'm going to buy. So I'm going to buy a contract and we'll see how it turns out. Maybe by the end of the video, we will have that confirmation of what's taking place. So I am in the position right now and I bought at 36.8175. So that is my entry point. If we start getting up to this 37.02 level, I'm going to be tempted to take gains. I don't know that we'll get up that high, but in any event, I like being long this morning. So you can see how initially yesterday we had this big gap down. If we were going to have a downward gap and go, you would have seen stacked red candle, stacked red candle, stacked red candle. We didn't see that. What we did see was off of the low of the day, this nice, big, long green candle. So if you came in all hot and bothered that the market was going to sell off on the big CPI number, and you shorted here and you saw this candle, you had better get the heck out of the way because you also have a bullish 1OP cross. So the market rallies nicely. Well, there are a couple of warning signs within this early rally that should have clued you that this move had more room to go. First of all, that opening price was breached right in here. So now you have a new high of the day and you're starting to retrace into this gap. Now you've got actually follow through. Whoa. Well, by the time this little bounce has played out, you can see that you are also above the halfway point of this gap. Closing price, opening price, you're more than halfway into this gap. If you were going to have a bearish trend day, you would not see this type of bounce because sellers would be in there pounding, 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 pounding because they're super aggressive and they're very anxious to unload their positions. So they're nailing bids. Well, when you get this type of move into a gap, you know there's going to be some follow through. Typically, there's going to be follow through. I get people asking me all the time, how do you know? I don't know anything, but what I do know is probability. And when I have certain patterns, the probability of having continuations or reversals is very high, and that's what I'm trading. So in this particular instance, when I see a bounce of this magnitude, yes, I would expect to see some retracement because we had a gap down. If the retracement is very brief and very shallow, lasting no more than 30 minutes, typically often 20 minutes or so, then I know that buyers are in there gobbling up everything that they can get, and sellers are stepping back a little bit, feeling that if they're going to sell, they'll be able to do so at higher prices. So we get a little bearish cross in here. This is a time to be cautious, especially on a gap down. So you would probably take some gains and just watch what's happening in here. You get this little retracement in here, and now we cross back up. And we also take out the high of the day. Okay, looks like it's time to stay in long positions. You can see how my position is working out right now. And we're through that high of the day. All right, back in the pool, back on the bullish positions. Long green candle closing on its high, filling in the gap on the first attempt. That's pretty good. So meaning we didn't rally up, test the low of the day, inch up, and then no, this is pretty much on the first move of the day. We are filling in the gap. Very impressive. We have a candle right here that's a brief little pause and then continuation. So in here you get a little bit of a pullback, which on these stronger moves, you're typically going to see 3 bullish flags before they start to run out of steam. There's your first bullish flag, there's your second bullish flag, there's your third bullish flag, and then you run out of steam. So another little technical analysis tip that I found useful when watching a 5-minute chart on the S&P 500. But as you get into the close of the day, a lot of this impetus has waned and you do start to see some selling pressure coming in here. You also have profit taking from people that have been long during the course of the day. So you get a nice little retracement in here and you have another bullish cross in here. That's a beauty. Now your bearish cross actually does produce a little bit and you're getting into a more normalized market as far as this indicator is concerned. Bearish cross there, a little bit of a pullback. Yes, this is an impressive rally. It could be program driven, it could reverse. But from a seasonal standpoint, the last week in October, the first week in November, those are historically the two most bullish weeks of the year. Why? Because typically we're coming out of a deep market trough. And so you've got lots of gains off of those lows, let's take a look at a D1 S&P chart. And you can see this is a monstrous bullish engulfing candle. I mean, it gobbled up the whole thing. This is what capitulation lows can look like, but I don't know if this is one or not because we would have to see lots of follow through, and I'm going to get into that as well. So in this particular case, you open on the low and you gap down. What you will not see in a capitulation low is you will not typically see a low like this and then a gap higher and then you go and you never ever come back. You need to see that big washout. I don't know that this is a big washout. That's why I don't think on a longer term basis we've seen the low, but on a short term basis, could this be the beginning of a small year-end bounce? Very possible. Depends on how earnings season plays out. So what you would want to see today is you would want to see a green bar would be great. But here's what I expect today. Today, I don't think the market's going to do much of anything. It's going to be digesting all of the movement from yesterday. If you can get a small, tiny green candle or a doji that preserves almost all of this long green candle, it probably means that Monday we're going to gap higher, and I would need to see that gap higher. I would also want to see this downward sloping trend line breached to the upside very quickly, like next week, quickly, when earnings season starts to ramp up. If I get that, then I think we're going to have a decent bounce. We'll have a chance to test some of the major moving averages. So let's put those up and see where they come into play. The 200-day is way out of range. I don't expect to see that anytime soon. This is interesting because you've got the 50-day and the 100-day converging around 395. That could be a possible target for us. So I think that's a decent goal for the market to get to between now and year end. We're going to see some selling pressure along the way. We are in a bear market, and the headlines are still very, very heavy. Inflation is running rampant. We've got the Fed in a relentless posture right now to where they don't care if economic data points start to deteriorate. They want to control inflation, and they are expecting that there's going to be economic weakness. So without that, they don't feel they're going to be able to tame inflation. So we should watch for some deteriorating economic numbers. Jamie Dimon said he believes in 6 months we are going to be in a recession, no question about it, which, by the way, JP Morgan Chase posted a decent earnings number, better than feared. So that also could help the market today. We'll see. Banks are going to dominate the early earnings season. Typically, as you head into earnings season, you're going to see a pretty decent market bid. And that's because everyone gets excited about what the big tech companies might possibly produce, especially when they've been nailed the way they have in the last month or so. Speaking of which, please go back and watch my last video to verify this point. But you will see in that video, I said, I think we're getting close to a low because the baby has been thrown out with the bathwater. What does that mean? When your biggest, strongest companies start to get hit hard during a market decline, that tells you that we're pretty close to a short-term low and that we're going to see a bounce. The converse side of that is also true. So when you get a market rally like we had a year ago, and the last leg of that rally is highlighted by laggards, horrible stocks, ugly stocks that have been pounded, pounded, pounded. When they start to bounce, and that's fueling the last leg of the rally, then you know a short-term top is in. Again, this is not technical. This is just watching sector rotation, but these are typically signs of a climax. And that's exactly what we got yesterday is we got a really nice rally. Could be program driven. Could this be a short-term low? We still have to wait. But why, Pete? This is such a dang good pattern. In fact, if you look here, you got a nice bearish engulfing candle here off of a relative high. Yeah, that was a good entry point. But if you go back and take a look at a nice bullish engulfing candle, you could see one right here. Wow. Hey, look at this. We made a new low here. Whoops, sorry, that's Microsoft. I better get into S&P 500, but you're going to see that same candle and that same setup. And you could come in and say, hey, this is almost a beautiful bullish engulfing candle. Not quite. Comes off of a new low of the year. Away we go. Oh, look at this. Follow through. Yeah, baby. Not so fast, because the market is in a downtrend. You're always going to have bid checks. So they're going to test it, test it, test it, test it. And nobody's really sure if this is the low or not, if it is a temporary bounce. If it is a long-term bounce, you're going to get those when everybody's stomach is around their ankles and they are so nervous and they're watching the market going, oh my gosh, are we ever going to get an uptick? Are we ever going to be able to rally out of this mess? When you get those gut-wrenching lows, and I mean they come down and they bottom out, and then you see stack green candle, stack green candle, stack green candle, stack green candle, then you know you have a long-term capitulation low. Please go back and look for this pattern in April of 2020. You can go into that long-term chart and see what it looks like. I might be able to show you here if we go back, but it is relentless buying once that low is in. This was the COVID low, and you can see the type of price action that you're getting off of that decline. So again, this is on a weekly chart. So those are some things to take a look at. Right now, I still got, I'm at basically a break even. I had a nice little bounce going in here. This is pre-open, so we're going to see plenty of volatility. I want to see this red candle turn into a smaller red candle. I want to see it close right around here, and then I'd like to continue to build and get back up to this level. Probably will be taking profits up here though, because again, we're pre-open. Once I get through the open, then I'm going to evaluate the price action. I often get asked, is the pre-open a predictor of what's going to happen during the day? Oftentimes, no. I think you trade the pre-open, you trade it independently, you look at the price action. Once the market is open, you've got so much more volume, and then you can really tell how the day is going to play out. Yeah, of course, you come in and you see, oh, the S&Ps are up 50, they're up 60. That's a little bit different because a move of that magnitude is typically going to have some legitimacy to it. When you have a move where the S&P is down 10 points or it's up 10 points, you're going to chop around. You can have a lot of movement back and forth without any real conviction. So those gigantic moves, you tend to weigh a little bit more, those really big overnight gaps. So as far as any kind of long-term capitulation low, I think that we've got a short-term opportunity here on the long side, but you do not want to jump in and assume that right now. You have to see that follow through, and you've got to start getting through some technical resistance levels very, very quickly. This is the downward sloping trend line I referenced. You want to start getting through this level right here very, very quickly. And when I say quickly, why does it have to happen quickly? If it happens quickly, it will be a sign that asset managers are panicking. They want to get in on a year-end rally, and they want to do it right freaking now because they don't think they're going to get another opportunity at this price point. And there is a seasonal bias. Typically, we see nice positive price movement into year end. Asset managers are usually pretty passive in terms of selling their positions. Why? Because they get paid based on assets under management. When the asset values are lower, they get a lower percentage. When the assets are trading higher, they get a higher percentage. Plus, when everybody opens their year-end statement, then they have a little warm fuzzy that the market did not close on its low of the year. And asset management is also a key part of bonuses for large brokerage firms. Institutional traders, same thing. They're all trying to pad their bonuses going into year end, so the selling is relatively passive and the buying tends to be more aggressive. That's the only explanation I have for year end rallies, and it makes perfect sense to me that you go into year end and even a small bid on light volume can drive the market higher and they can get those positive prints. They can mark their positions, so to speak. When you don't get that year end rally, you have to be very, very cautious. And if we go back and we take a look at what happened last year, this was the price action heading into last year. Go back and watch my videos from last November and December, by the way. Please do that. Don't take my word for anything. So we start rallying up, and this looks like, hey, we're going to have a nice year-end rally, and then blam. So this is in November. These are the most bullish weeks of the year. Blam. Not so fast. Uh-oh. That's a warning sign. Typically, November and December, you're going to grind, 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 grind higher. Okay, so we rally back to the all-time high. Blam. Oof, this is in December. Also unexpected. But here comes Santa Claus and we rally. When I saw this price action, it told me that 2022 was going to be a very tough year. Then we start the year off, got a nice little compression here. Blam. Long red candle closing on its low off of the high. Yeah, this is a warning sign. So those are things to watch for. That's why I feel that, yes, we are due for a bounce in here. I know the headlines are so dang gloomy, but there's a ton of cash sitting on the sidelines. I think some of it is going to be deployed. So we want to see the top of this long green candle preserved. A doji today or a small little green candle would be good. Typically, after a monster market move the previous day, you are not going to see a big move the next day. So these gains have to be digested. If they are, it will be a sign that this is not just program driven, that there's actually some legitimate buying taking place. So then Monday we would be looking for a small gap higher, maybe even a big gap higher in a long green candle that starts to get close to this resistance level. We need to see it immediately because we need to know that asset managers view this as an excellent long-term entry point. If they do not feel that way, you will not see that long green bar and you'll start to see this fizzle out and then we'll gradually roll over. That's a warning sign that we could test major support. And by the time we would get into that type of price pattern, we're probably going to have another week to 2 weeks worth of earnings releases. And what will be more important is not the earnings release, it will be the guidance. What does the company see in the future? What is going to be happening down the road? How is the quarter going to play out? How is the next quarter, next year going to play out? What are some of the longer term macro forces that these CEOs see? So, as you're evaluating earnings, especially for companies that you might be tracking, make sure that you pay particular attention not just to the number, but to the guidance. That will help you assess whether or not this company is a long-term buy or if it's something that you might want to hold or if it might possibly have some longer-term clues in terms of market direction. So the last pick that I gave you was TMUS, and that was before the open yesterday. Wanted to talk about gap and go formations. TMUS did open lower and it instantly bounced. And given the fact that the market instantly bounced, you should not have been in there pounding a gap and go open with the market also not selling off and instantly taking out the high of the day. So you should have held off on this. Okay, no, this is not a particularly good pick because the market wasn't cooperating. But TMUS did break that nice upward sloping trend line that I showed you. And I told you that the goal was the 200-day moving average. Well, you hit your goal right pretty much on those opening prints right there and the low of the day. So wouldn't be real wise to short something when it's actually hitting our target. So not a particularly great pick. I still think there's going to be some weakness in it if the market decides that this was just a temporary bounce yesterday and that it was all program driven. But let's see if we can find a bullish trade. I'm going to go in. I haven't done any searches. I haven't done any scans. So I'm going to go right to one of my go-tos. I'm going to go right into Pop Bull to see if there's anything there that was interesting. Energy, it's hard to find a better sector than energy. So as I scan through this, I'm going to see if there's anything that looks somewhat attractive to me. And I'm looking for something non-energy because that's my fallback. I can always go into the energy sector and find something I like. Starbucks has to get through this downward sloping trend line. Very, very choppy, but it has held up well. That's an energy stock, GILD, also very choppy. Not seeing anything that grabs my attention, with the exception of Merck and Philip Morris. Philip Morris actually looks pretty decent in here. MO, you can see downward sloping trend line, breach to the upside through the 100-day, still has to get through this horizontal resistance. I think I can find something better. I'm going to keep looking. And Twitter, obviously takeover news, so we don't want to be in anything that's going to be driven by that news. SLB, this is a really nice little bullish flag. You've got your flagpole, you've got your little retracement, you've got a new relative high. SLB could work very nicely. I continue to take a look very quickly, but right now, SLB might be the one that I like the most. Netflix had a nice bounce off the 100-day moving average. This looks good, but lots of resistance in here, so I'm not too keen on that. And now we get into a lot of weak stocks that still are below these major horizontal resistance levels and these downward sloping trend lines, so I have to be watchful of that. JP Morgan earnings, so that's going to be possibly a good pick. Yeah, this is a hard one to pass on. This is such a nice formation because you've got a nice solid downward sloping trend line. You have earnings before the open here. Stock is able to hold on to the 100-day and 200-day moving averages post earnings when the market was selling off. And now you've got this gigantic bullish engulfing candle. I like Pepsi. Now, Pepsi is not a huge mover. Pepsi is not the kind of stock where you're going to bang, 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 make a huge 10% return on it, but it's a very nice grinder. So if we start to see some really positive price action in the market, I think Pepsi works. That is the long green candle we want to preserve. This halfway point, this 50-day moving average serves well. Yes, if it retraces to this, selling an out of the money bullish put spread below this 100-day, 200-day moving average, that is a nice looking trade. And that comes into play around the 50-day moving average is at 171. So we want to see that preserved. If it is, and the market looks pretty decent, I like selling a bullish put spread keying off of that 169 price point because I don't believe the stock is going to go back below there. I'm going to take a look at just a couple more and see if there's anything else that looks better. And I'm not seeing anything right off the bat. Plus, Pepsi is what they call a defensive stock. People are always going to buy Cheetos. They had excellent earnings, fairly recession proof. So I think Pepsi works. I'm going to stick with Pepsi, watch for a market bounce. So that's what we want to see. Let me put in order in to exit this futures position. And while we were doing all of this, I should be able to make some pretty nice money on this trade. And I'll place a limit order out there. See if I can grab a 15-point gain. That'd be a nice way to start the day. I need that little pop right in here, and I'll hit that target. Right now on that one lot, I'm up about $560. So I'm not going to let this turn into a loser. I'm going to do a very quick recap, though, of everything that I've discussed right now, starting with the S&P 500 on a 5-minute basis. Yesterday, we had that big gap down. We instantly, oh, I just got filled. So I have a 15-point winner on the S&P futures. You can see it right there. There's my exit. I entered around 36.82, actually a little bit less than that. So nice way to start the day. We have this sell-off yesterday. We instantly take out the high of the day and we start creeping into the gap on a bullish 1OP cross. This is a nice long green candle. The opening of it is preserved on this little retracement. We can expect that sellers are going to come in and pound, pound, pound. They can't take out that open. Got a bullish cross in here on 1OP. Now we start stacking, filling the gap. Away we go. I'm sorry, I'm on the wrong symbol right there, but similar pattern. That was IBM, which happened to mirror what was happening in the market. So now we climb up, could be program driven. It leaves us with this big bullish engulfing candle. We want to see the high from yesterday preserved today, and then we want to build on it Monday, and we want to start challenging this horizontal resistance and this downward sloping trend line in short order. Big, big, important piece of information. On heavy volume, because that will tell us that asset managers are in there buying. They see that this is an opportunity for a possible year-end rally, and they don't want to miss it. Are they going to go full allocation? Probably not, but they're going to try and do anything that they can to goose their performance this year. In general, asset managers don't care if they make money or lose money. I know I'll get a lot of flack for this. They only care that they outperform other asset managers because that's how they attract new funds. People are always looking at who's the best performer. Gee, everyone was down last year. Who was down less? And that's how they're evaluated. So if they can come in and take a position and make some decent little money into year end and goose their performance by a percentage point or two, that's great for them. Then they've outperformed on a relative basis. So we'll see if we get this little bounce in here. I think Pepsi is a stock that if we do get that little bounce, you're going to see some follow through on it just to play it safe instead of going out and buying calls on Pepsi. I would look for any kind of little retracement in here, preserving that 50-day moving average, then selling an out-of-the-money bullish put spread, keying off of that 169 level, maybe a 169, 167 bullish put spread, trying to get 50 cents for that type of spread would be fantastic if it's available to you. And I feel that this stock is going to be able to hold its own because of the positive earnings reaction and those major moving averages. Thanks so much for watching. There is so much information in this video. You might want to watch it a couple of times. I'll try and get videos out as I can, but I've got a lot going on in my personal life. I've got a lot going on also professionally with things that I'm working on, so I can't keep the videos coming as often as I'd like. Thanks so much. Good luck with your trading. Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.